Welcome everyone to the third session on day one of the Modern Investor Summit. I'm Stefan, a global analyst here at Finimize, and I'm really thrilled to be guiding today's discussion as we dive into the 2025 outlook for investors. Now, before we begin, I just want to extend a massive thank you to our session partner, Charles Schwab. Charles Schwab is a leading provider of investment services, empowering individual investors and organizations alike. They're known for their commitment to putting clients first, delivering comprehensive investment tools and expert guidance, and championing long-term financial success. And thanks, of course, to everyone joining us. Now, please feel free to introduce yourself in the chat box with your name and where you're tuning in from. In terms of format, it's going to be a 30-minute panel discussion with, of course, time at the end for your questions. Remember, you can just submit your questions in the Q&A box below. Now, today, I'm joined by two exceptional guests from Charles Schwab, Ann Sonders, Chief Investment Strategist, and Richard Flynn, Managing Director at Charles Schwab UK. Both Ann and Richard bring a wealth of expertise in understanding market dynamics and guiding investors through economic cycles. So today, super exciting session. We'll explore what's next for the global economy in 2025, where to find the most promising opportunities, and the key risks on the horizon. So welcome, Ann. Welcome, Richard. It's a pleasure to have you with us today.
Thanks, Stefan. Nice to be here. Hi, Richard.
Hey, Ann. Thanks, Stefan.
So let's start with the big picture, and maybe let's start with you, Ann. What are the top three macro trends you think will shape markets in 2025?
So leaving aside the politics of the incoming administration for a moment, I think that the top issue is monetary policy, and the Fed being very data dependent means that essentially all of us are at the mercy of every data point. I do think that with the U.S. Federal Reserve having a dual mandate, price stability and full employment, I think their sights are a little bit more on the employment side of their dual mandate in terms of policy setting as we head into 2025. Back to the politics of the incoming administration, a huge number of cross currents associated with the way policy is typically set under soon-to-be President Trump. We learned that in 2018, especially with regard to trade. So it also puts investors at the mercy of social media and how particularly tariff-related announcements are often posted on his platform. And there are associated cross-currents given the combination of tariffs and immigration in terms of both the inflation side and the growth side. And the combination of the two, it's hard to argue against them being somewhat stagflationary. In other words, downward pressure on growth and upward pressure on inflation. And then I guess the third trend, of course, would be geopolitics. It's hard to gauge the impact other than typically through the energy markets. That's been fairly muted in this environment, but we're still in hot wars in a number of places, and that could be yet another volatility driver.
Richard, any other to highlight, or is there one in particular that worries you or you think is particularly important right now?
Well, there's a couple from this side of the Atlantic over here in the UK, which I think are quite interesting. Firstly, inflation. I think there's a lot of scar tissue here in the UK population. Obviously, inflation has tamed a little bit over here, but still things are very, very expensive relative to years gone by. And I think people are possibly a little concerned or certainly interested to see the impact of, for example, the increase in national insurance obligations on large employers, which was an outcome of the last budget, whether that will extend to higher prices that retailers will pass on those costs to consumers is something of interest. And then secondly, as Ann says, geopolitics. I think this week here in the UK, there's been a lot of focus on the government and their approach to the US and China. And, it's a quite narrow path that Keir Starmer and the UK government will have to walk to be able to ensure that it's well positioned for the new global economy and the realities of the current geopolitical environment.
Thank you. So, I mean, fundamentals always matter, but it's not the only thing that matters. And actually, this morning, I just read that some crypto bro in his 30s bought that famous duct tape banana artwork at an auction for something like £5 million and then ate it. So, I've got a lot of questions, but the real pressing one is, should we be worried about frothy investor sentiment?
Yeah, I think that is a concern. It's a background concern. We have to keep in mind the fact that sentiment, certainly at extremes, all else equal, is considered a contrarian indicator, but with nothing resembling timing precision. So I don't think there's such a thing as a good market timing tool, but there are some that maybe have a little bit better a track record. Extremes of sentiment is one, but really just establishes maybe a condition a little bit more ripe for downside to the extent that there's a negative catalyst. As we learned in the late 1990s, you can have sentiment get frothier and frothier and frothier, and it took quite a while before you ultimately had a downturn. I think the froth this time is a little bit more pocketed than just broadly in the equity market. You mentioned the banana artwork. You see it in things like leverage, single stock, exchange traded funds. You're seeing it in the crypto space. It has some similarities to when we were in the SPAC and the meme stock craze, or the short vol implosion that came as a result of a lot of the leverage bets in those inverse volatility indexes back in the early part of 2018. So when you do get more sort of specific areas of froth, you can sometimes have a corrective phase in those areas. I mean, we saw huge drawdown in the meme stocks. SPACs went from being sort of market darlings to complete duds without it necessarily bringing the market down overall with it. So I think this looks a little bit more like those backdrops versus, say, a late 1990s where froth was really broadly spread across the sort of equity landscape.
Mm-hmm. Richard, I think, on that side of the Atlantic, it's a little bit different in terms of sentiment. But anything to add on that?
Well, I think it's possible that we'll see a proliferation of bad modern artists trying to sell their work to crypto bros by the sounds of it. But yeah, I think, the one thing about the UK retail investment landscape is that it's probably maybe 10 or 20 years behind the US in terms of its impact on markets, and retail investors and retail investing in the UK is really something that is growing at quite a clip, but it's certainly not at the stage where investor sentiment, certainly on the retail side of things, can drive markets upwards or downwards, given the relatively low participation rates here. But that's something that's definitely changing. And yeah, fair play to whoever sold that banana. That's solid. That's solid investing work.
Okay, now a question that I love to ask, and that's really your opportunity to flex those contrarian muscles. So Lisan, what's one thing that almost every investor think is true, but you think is wrong? Or, of course, alternatively, one thing they perhaps dismiss, but you think is actually super important.
So I'm hoping you're okay if I answer it somewhat broadly as opposed to, one micro level specific thing. I think that there is this belief system, even if it is not something that investors think of inherently throughout the course of the investing day, figuratively, that it's what we know, meaning about the future, that matters. It's trying to gauge what's going to happen, whether it's within the market specifically or, say, macro drivers that impact the market. And that what we know, if we can glean what's important, that leads to good investment decision making. But I always say it's not what I know or or anybody knows that matters, because none of us know. It's in the future. It's unknowable. It's what we do along the way. And it's the important stuff, but arguably maybe a little more boring to talk about, whether it's diversification across and within asset classes or the power of periodic rebalancing. It's much more interesting to have somebody come on, say, a platform like this and pontificate on what they think is going to happen in the future, and as a result, what that means for how you structure a portfolio, how you focus on the day-to-day. But again, that's the unknowable, and it's not what we know that matters, it's what we do.
Thank you. Maybe let's just stay with you for a second, Lisanne, because I think you have some views on that one specifically. Will 2025 finally be the year of stock pickers? Will active investors finally have an edge over passive investors? And if so, which regions, styles, and sectors would you favor most and least?
So I'm not sure if I would go as far as saying that active will have a significant edge over passive from a consistent performance perspective, but I don't think it's a stretch to say that the playing field has leveled a bit more for active relative to passive. We've had the return of the risk-free rate. There is a bit more price discovery. There is a tighter connection between fundamentals and stock prices, and all else equal, I think that that's beneficial for active management. From a sector perspective, what we have been seeing, and it really kicked into higher gear starting around the mid-July period in the US market when we had a bit of a corrective phase. NASDAQ had a 13% correction. S&P didn't quite hit 10% correction territory, but we started to see pretty fierce rotations, and that has continued. A lot of really fierce sector-based rotations under the surface of cap-weighted indexes that continue to do quite well or trading at all-time highs, but a lot of churn and rotation under the surface. I think that is going to continue. And it's one of the reasons why, although we do have sector recommendations, we do publish outperform, underperform ratings, we think factor-based investing, basically just investing based on characteristics, makes more sense than monolithic sector-based investing, in part because of the expectation of continued fierce rotations. And where there has been more consistency in leadership is at the factor level. And our emphasis has been on higher quality factors. So strength of balance sheet, profitability trends, strong free cash flow, high return on equity, high interest coverage. But I think an important shift that may be underway as we move from 2024 into 2025 is from, strong versus weak to better versus worse. And I often say that better or worse often matters more than good or bad. And I think from a factor perspective, the level, the good versus bad, the strong versus weak was important in 2024. I think as we head into 2025, I think it's going to be a bit more about rate of change, sort of an improvement in profitability trends, an improvement in interest coverage, an improvement in free cash flow. So you catch some of the lower quality companies that you can often get leverage to a turn back up in the economy to the extent the Fed stays in easing mode. You get that rate of change improvement. But I still think you want to stay up in quality, but focus a little more on rate of change versus level.
Thank you. Now, Richard, a question to you. So, an exercise I love to do before investing is called a pre-mortem analysis, where basically you imagine, an investment fails spectacularly in the future, and then you work backwards to identify the causes. So, let's fast forward to December next year. What's the headline that would have shocked everyone at the start of the year? What would really potentially surprise markets this year? Drop your boldest, most contrarian take.
Wow. Okay. I mean, it's a tricky question to answer, but it's clear to anyone that geopolitical risks are highly elevated. Really, anything could happen. You could look at, for example, the consequences of some significant event in the Middle East, where you could find the entire energy sector severely restricted, and the consequences on inflation happening very, very fast indeed. Not just the regional consequences, but the global consequences. And something like that could have a significant knock-on impact on absolutely everything. There's still a huge amount of uncertainty about what could happen in Ukraine, and and then Put alongside that, putting to one side the conflict events, you're dealing with the potential for a significant tariff war. And if you look at the rhetoric versus what is possible to happen, as Lizanne said earlier, no one really knows. And I think that's the biggest challenge for investors when you look forward and trying to say, okay, we think this could happen, that could happen. The reality is that no one knows, and you just have to prepare through diversification and through rebalancing, staying engaged. You have to be ready for the events that naturally happen and have always happened every year since investing has existed. If you go back over the last 100 years, I don't think there was ever one 12-month period where there weren't significant events that impacted investors one way or another globally. And so factoring that in, knowing that it's going to happen, something significant will happen, you just don't know what, you have to ensure that you have sufficient safety nets under your portfolio. And you can do that through diversification, balancing, conditional orders, etc. The boring stuff, as Lizanne alluded to. So unfortunately, I can't predict anything beyond the fact that unknown events will occur.
Fully agree. Thanks a lot, Richard. And now, Lizanne, last question. So, actually the same question, I would say, but is there one tail risk that worries you particularly going into 2025?
Sure. And by the way, I think that when you talk about the tails, I think the tails are a bit fatter in this environment. And I would suggest on both the left side of the distribution and right side of the distribution. Richard rightly so talked about tail risks associated with geopolitics. I suppose a tail positive risk would be maybe peace breaking out in places where that's not expected. So I think there are fatter tails, but I think a significant escalation from a trade war perspective, and combined with what the stated plans are with regard to immigration in the United States, a pretty nasty combination could be a tail risk that, again, as I already touched on, puts pretty significant downward pressure on growth and upward pressure on inflation. The Peterson Institute here in the United States has done really significant work that's getting cited everywhere because it was a real deep dive into the combination of proposed policies and the implications for the growth backdrop, including things like employment as well as on inflation. And it's a pretty toxic combination. Now, what we already know, as we've seen with what Trump pre-announced potentially on imports from Canada and imports from Mexico, is that it's a negotiating tool. But to the extent that there's still a faction in the incoming administration that truly believes tariffs are beneficial from a revenue generation perspective, I would potentially take the other side of that when thinking about the tariff generation of revenues in net terms once you take the ripple effects into consideration. But a significant escalation in a trade war with deleterious impacts on not just US growth and inflation, but global growth and inflation. I don't think that is baked into assumptions at this point.
Thank you, Lizanne. Okay, so now let's move on to the Q&A. So let me open the questions. Okay, the first question is, what will happen to the property sector in 2025?
US or UK?
Maybe let's start with the US.
Okay. Well, and then I guess I would ask a follow-on question. Are we talking about the commercial side of things or the residential side of things? I'm not sure if that was noted but let me know how you'd want me to answer it, or
I think you can cover both. That would be interesting to hear.
Okay. Yeah, I mean, residential, the housing affordability measure is still really, really depressed. And it's got, three pillars to the stool of housing affordability. It's the price of homes, it's the mortgage rate, and then it's incomes. The income side of things has been fairly healthy, but even when we had a big decline in home sales in the early part of the pandemic, and then at different points subsequent to that, we didn't see the same kind of drawdown in prices. So prices remain elevated. And of course, mortgage rates, even though down from the peak, remain relatively elevated. So there is plenty of room for improvement there. We're starting to see tiny little signs of hope in life, but a lot of that is predicated on the Fed staying in easy monetary policy mode, and that is uncertain, as we already touched on with regard to the data dependency nature of the Fed. It's also the case that residential real estate in the United States can't be looked at monolithically. There are different states and regions and metropolitan areas and urban areas and segments of the country where the data looks quite healthy and other areas where the data looks quite weak. So I think you do have to sort of fine-tooth comb it a little bit when you're talking about residential. On the commercial side of things, we're in the midst of a pretty meaningful maturity wall, but it is still spread out over time. The exposure is very minimal up the cap spectrum in the larger financial institutions, the larger banks. Most of the exposure is in the small to medium-sized regional banks. And of course, many of those same banks were plagued by what happened year and a half, year and 3 quarters ago when we had the mini banking crisis. I think there's opportunities on the other side. There's a lot of distressed funds that are being put together to take advantage of the weakness, and the weakness is largely concentrated in the office space. Other components of commercial real estate, whether it's in multifamily or healthcare or education or warehousing, actually are in pretty decent shape. And even within offices, big differences from one sort of city area, metropolitan area to another, Class A versus Class B, the convertibility of office structures. So I'll finish on the commercial side the same way I did on the residential side. I don't think you can analyze commercial real estate in the United States through a monolithic lens. I think it requires a fine-tooth comb to see where the exposures are greatest and where the vulnerabilities are highest from a regional perspective.
Very interesting. Thanks, Lisanne. Richard, you touched on the October budget. How do you view the potential increase in costs playing out in reality on tech startups in the UK? Would also be interested in hearing more on your views on the potential impact of US tariffs on the UK market. So 2 questions in one. I guess you can choose which one you'd like to answer first.
All right. Well, I know very little, unfortunately. I know there's a lot of tech startup folks who are part of the Finimize community, and I'd be pretty disappointed to let them down with a poor answer to that first one. So I'm sorry, I wouldn't be able to answer the consequences of the budget on their companies and their jobs, other than it's a tough time to be an employer for sure. So particularly starting up in a difficult industry with quite tight margins, it's something to absorb. What I would say is on the tariffs, one of the benefits the UK economy has is that we are fundamentally a service economy. We don't really export goods to the US to the same extent as some of the other countries, notably the ones Lisanne mentioned, Mexico, Canada, and obviously China. And primarily that's what tariffs will impact. What we are, however, is a consumer of American goods, which are principally manufactured overseas. And if you look at the way that it would impact UK residents or taxpayers, really, you can expect potentially as part of a US tariff war or trade war being instigated by the Trump administration, that consumers globally will end up having to pay more for US goods that are potentially manufactured outside of America. So we're not going to be immune to US trade policy, and I think it's something to factor in. The globe, or the international market, is hyper connected now, and it used to be the saying that America sneezes and Britain catches a cold. You could extend that to everywhere in the world now. It's not just any one country, because I remember when people were talking about Brexit, I think the phrase was, it's like trying to take the eggs out of a baked cake. I think the global economy is kind of similar. The cake has been baked, and we're all connected to each other in different ways. And so the trade war is something that investors all around the world need to pay close attention to, because it will impact their personal choice, their ability to spend money on the products that they will buy, without question.
Thanks, Richard, and very nice and useful expression. I might steal in the future. Next question: any thoughts on the automobile industry, especially with regards to electric vehicles and the broader oil industry? Maybe Lisanne.
Yeah, I mean, I can speak only very broadly because I'm not an analyst. I don't cover any industries, including autos. But clearly, there is a lot of pressure from a tariff perspective based on the sort of incredible gains made by China in the EV market, with a cost significantly lower than some of the more popular EVs in the United States, and a lot of production thereof moved to Mexico. And so part of the reason ostensibly for the increase in tariff rhetoric on Mexico, and goods coming into the United States from Mexico, is an indirect punishment of China, given the advancements made. One of the problems in the United States, and one of the reasons why we've seen some backpedaling on the part of auto manufacturers, maybe not fully back to combustion vehicles, but hybrid vehicles, is we just in the United States don't have anywhere near the kind of infrastructure to have a much larger fleet of EVs. There's certain areas like California where you find them everywhere, but there is still that range anxiety. And I think the desire to move more quickly to sustainability via EVs went beyond, from a speed perspective, the necessary infrastructure in order to support that. So, but I'm not going to comment on individual auto companies because, again, I'm not an analyst and I don't cover the stocks.
Okay, so let's switch gears a little bit. What role should alternative assets play in a well-diversified portfolio for 2025 and beyond?
So Richard might have some thoughts on this too. The one thing I'd be really careful about, particularly if you hear it from others, where they'll provide a numerical, a percentage answer to a question like that. Maybe it's the nature of who we are at Charles Schwab, with $10 trillion of client assets, all of whom are individual investors. There is no one cookie cutter asset allocation inclusive of alternatives that is right for, in our case, $10 trillion worth of client assets. So it really depends on a number of factors: where you sit on the risk spectrum, your liquidity needs, your income needs, the percent that you're willing to either tie up with a little bit longer duration in terms of access, or a little bit less transparency than you get in the traditional public markets. It's a great way to further diversify outside of just the traditional stocks, bonds, cash allocation. And we've further democratized investing to allow not just the ultra wealthy to have access to alternatives. And it's part of the platform that we are building out. But in terms of how much exposure and in what form that should take, that is going to be individual investor specific.
Richard?
Yeah, if I could add to that, Stefan, I think one bit of advice I would give everyone here is, if possible, watch this session back again, rewind, and listen to Liz Ann's answer from earlier relating to what we might think is true and what investors don't, and the other way around, that contrarian approach. She gave a perfect answer about the dangers of ignoring the psychology of investing. And one of the areas of investment psychology which I find fascinating is social proof. People tend to do what other people do just because other people do it. And so when you look at the role of alts, or if you're asking about the role of any particular investment, whether it's an asset class or an individual investment, individual stock, you have to consider, why am I doing this? Is this for me? Is this my individual choice, or am I doing it because other people recommend it? And what the best investors do is they have a very, very clear identification of why they're investing, what their exit points are, what their risk profile is, what timescale they're investing to, and their own personal approach, not just to risk, but to the kind of portfolio that's appropriate for them. And they have it with that clarity. They're able to manage their portfolio and their investments in the best way possible, rather than being driven by other people's judgments of what they should be doing. And so I would strongly recommend that the best thing you can do as an investor, rather than learn about financial analysis or reading corporate earnings, etc., is just focus on the psychology of investing first, and realize those pitfalls that people fall into, where they find themselves creating portfolios under someone else's standards and not their own.
Wow, what a strong ending. I think we could do a full session on that, by the way. Super fascinating a topic, but thank you so much. Unfortunately, that's all the time we have for this session, but thank you so much, Richard, Lisanne. It was absolutely amazing. Lots of very valuable insights shared, so thank you so much. You can actually join our next session again with Charles Schwab on January 14th. So hopefully you enjoyed this session, but don't go anywhere because the next session will be featuring Meredith Whitney, the renowned Oracle of Wall Street, and that starts in 15 minutes. So see you at the next session. Thank you so much and have a great day.